Adjustable rate mortgages, ARMs, ARM. An adjustable rate mortgage is a mortgage where the interest rate can adjust over time. To learn more, stick around after this. I'm Dan with homebuyer.com. My NMLS is 227607. Our lender NMLS is 423065. We're part of Novus Home Mortgage, a division of Exonia Bank. You can read more about homebuyer.com in the video's description, including our lending coverage and some very important disclaimers. Also, don't forget to hit the subscribe button because this channel is filled with excellent mortgage video. And I'm a mortgage guy. Talk to a separate licensed expert for your legal, tax, and financial advice. Okay, this video is about ARMs, adjustable rate mortgages. Adjustable rate mortgages are mortgages where the interest rate changes throughout the life of the loan. ARMs are the opposite of fixed rate mortgages, where the interest rate never changes, where the rate stays fixed. For the purpose of this video, we'll be talking about a certain type of ARM, by the way, and that's a first mortgage lien ARM, a primary mortgage on a home that uses the adjustable rate option. This could be for conventional loans, for FHA, for VA loans. They're all pretty much the same. Your mortgage lender can walk you through the specifics as they pertain to you, but this video will give you a good, broad understanding of how an ARM works. And the important thing to remember here is that ARMs are just mortgages. They have a starting balance, a loan term of say 30 years, and they have rules that you need to follow, like keeping your home insured, just like other loans. What's different about an ARM is that its interest rate can change. And even that part is heavily regulated with rules in the lending paperwork that state by how much an ARM interest rate can change in a year or by how much it can change throughout the life of the loan. And the rules of the ARM are governed by 4 parts, which we're going to get into now. First is the starting rate. This is the interest rate at which your ARM begins. Sometimes starting rate is called an introductory rate. It can last for several months or several years. It's pretty common to see 5 years or 7 years as that initial period. You may decide with your lender to choose a different length of time, but while that rate is in effect, there's no change that's allowed to your rate. Your mortgage rate cannot change during that time. Same rate, same P&I payment every month until the introductory period ends. But then the mortgage can change. It can adjust, but also not randomly. Adjustments in your ARM are governed by specific predetermined rules. They're established at your closing. They're listed in your mortgage paperwork. And one of those rules is that your rate can't just adjust to whatever your lender wants. ARMs don't work like that. Any new adjusted rate is based on a formula that is equal to a fixed number, so a constant, we call it a margin. And you take that margin and you add it to a variable that's also shown in your loan documents. That's called an index, and that's your new rate. Margin plus index. As one possible example, if you have a conventional adjustable rate mortgage and your constant, okay, the margin, if it's 2.75% and your index is currently 3.25%, your new adjusted rate, assuming other ARM rules are met, your new adjusted rate is 6%. But let's say something goes haywire and the ARM adjusting formula calls for interest rates to jump. Let's say they spike, really spike, some double-digit number. For you, luckily, they can't, because another common feature of ARMs is the cap. Caps are the limits, boundaries for how much an ARM can change within any given adjustment, and also cumulatively over the loan's entire life. Caps vary by loan product, by lender, but they ensure that any future change in adjustable rate mortgage interest rate is gradual, it's limited, and it's bound. So an example of a cap could be an ARM with a 5-year introductory period and caps that limit interest rate changes by 5 percentage points after the first 5 years, and also 5 percentage points over the life of the loan. So if your starting ARM interest rate was 5%, the highest your rate could ever go would be 10%, even if margin plus index says your rate should be 15. Caps. When we talk about adjustable rate mortgages, it's important to understand that ARMs are just one of many mortgage options that may be available to you. Okay, they aren't inherently problematic, they aren't risky on their own. They can be a practical choice depending on your financial goals and circumstances, or they may not be. But ARMs aren't even that common. According to the Federal Reserve, a study showed that ARMs accounted for about 4% of mortgages that were made overall in 2021 when mortgage rates were generally low. And today, as rates are a little bit higher, ARMs are about 10% of the market. The Fed concludes that rising rates cause people to look for more affordable options for their mortgages, which temporarily ARMs can be, but they may not be later. When the loan adjusts, okay, so there are some circumstances where ARMs do make sense and some where they don't. And this is general information. It's not specific to you. Discuss your ideas for an ARM with your lender before choosing one. But some of these scenarios where ARMs might make sense to you may jump out. For one, if you know you're going to sell your home or refinance it in the next few years, then you can get an ARM with an introductory rate below fixed mortgage rate levels today, an introductory period that's within your time frame to sell. The ARM may save you money. It can be good for a starter home or a short-term living situation. Another scenario is if you don't mind taking a risk against your mortgage rate. Sure, ARMs can adjust higher, but they also can adjust lower. And if you are willing to take that risk that your rate may go up and you can stomach a higher payment in the future, ARMs could be a way to make a financial strategy based on your expectation of the future of the U.S. economy, based on your margin plus your index. Now, one time that an ARM may not be the best choice is when affordability is your only reason for choosing an ARM. Say, for example, you're stretching your housing budget. Yes, an adjusting ARM can adjust down in the future. Maybe yours will. But if it doesn't, and you can't support your new adjusted payment, your bills could stack up, you could fall behind, and you could have your home go to foreclosure. And for some people, ARMs are high stress for that reason, and that becomes another reason why maybe not to choose an ARM. If the thought of having an ARM makes you nervous or uncomfortable or causes you to lose sleep, there will be no amount of savings an ARM can give you that will ever make that better. The stress never leaves, and the cost of the stress is more than you'll save. And that's it. That's adjustable rate mortgages. In the right situation, yes, they can be the right choice to finance your next home, but they may or may not be right for you. Discuss your goals and needs with a trusted mortgage lender. I'm Dan with homebuyer.com. Remember that pre-approved buyers do better. Happy home buying.